I recently came across an interesting article on the TSI Trader blog. The gist of the article was that gold miners have become extremely cheap. The title of the post, "My Vote for the Most Stupid Cheap Miner," gives you an idea of where the article is headed. While I won't tell you the particular stock that was named, you can find a link to the post below this video. I will tell you that my resulting research led me to look at the IAG Corp, stock sign IAG. I was very intrigued to see a PE of under 8, a dividend yield of almost 4%, with a conservative payout of well under 50%. From there, I clicked the link to look at options. I was considering only call options, and particularly the call options for April of this year, a short time away. The option that most intrigued me was this April 13th option with a price of $7 and a premium of 30 cents per share. While the chart didn't look exactly like this when I made my purchase, this is where my numbers came from, and I'll show you in detail what happened when I bought this stock and sold this call option. This is a simple spreadsheet I created to help me evaluate options. It's set up so that I could compare up to 5 stocks, or a single stock. I could use different option dates. Today, I'm only going to look at IAG, and again, it's the April call option that I sold. The price when I bought the stock was $6.81. The call value, as you've already seen, was 30 cents. The call date, which wasn't shown, the exact date, is April 19th of 2013, at a call price of $7. When I sold this option, the days that I would be holding it were 36. And here's what the spreadsheet starts to do for me. It calculates my profit on 100 shares, because that's how options are sold. So 30 cents times 100 shares gives me $30, and my spreadsheet calculates that. It gives me a profit percent of 4.41%. Now that sounds tiny, but again, I'm talking about a holding period of 36 days. Almost 4.5% in 36 days sounds like a miracle to me. Where it gets really crazy is with the annualized profit. And what this does, I'll show you the formula. It compares a full year to the holding period of mine, 36, and multiplies it by the profit, by that percentage. And it gives me an annualized profit of 44.66%. Now that sounds ridiculous, and the truth is it's unobtainable for a couple of reasons. First, I'm not going to be able to roll these options one after another without losing days in between. But I don't expect that's going to cost me too much. The second thing that you'll note is these figures do not include trading costs. And that's something that I'll talk about more in a moment. The next thing to look at is, what about my profit if the stock is called away from me? In other words, what if I'm paid $7 for that stock on April 19th? While it's true I've lost the stock, I've gotten all of my money back, excluding trading costs, and a profit of $49. That gives me a percentage profit of 7.2%. Again, outstanding for 36 days, or an annualized profit of 72.95%. Again, this does not include all trading costs. What it also doesn't include is the fact that I may give away further upside in the stock. Suppose the stock trades for $7.50 by April 19th. Guess what? I lost that 50 cents a share. Suppose the stock drops to $3 a share. I've lost out big time then as well. But those seem to me relatively unlikely, and those are risks I'm willing to live with to get a taste of these kind of returns. The last problem that I see here is that trading costs could easily eat up my profits, whether you figure a profit of $30 or a profit of $49. But remember, that's based on 100 shares. This is a very inexpensive stock. In truth, I sold 10 call options on 1,000 shares. So my profit before trading costs will be either $30 or $490. And if you figure trading costs are likely to be $7 to $10 on either end, I can certainly live with that. If you have any comments, any suggestions, if you want to criticize what I've done here, by all means, please do. I'm trying to learn about options, and I'd love to hear what you have to say.